In 2019, a financial planning firm ran a study on retirement readiness across Americans between 60 and 65 years old. The median savings balance was $94,000. At $2,000 a month in withdrawals, not luxury, just groceries, utilities, a car payment, that money is gone in less than 4 years. Most people look at that and think the problem is the amount. Save more, retire later, spend less. But the research pointed somewhere else entirely. The people who retired with that balance had been saving consistently for decades. The issue was not the discipline. It was what the money was doing while they saved. Here's the question that the study could not answer. If the same $94,000 had been invested differently 30 years earlier, what would that number actually become? That gap between what patient, low-cost investing can mathematically produce and what most people actually end up with is what this video is about. And the reason most people never close it is not ignorance. Nobody explains the three things that quietly determine whether the math works in your favor or against you. My name is Alex, and if you have ever looked at your investment account and felt like the numbers should be further along by now, pay attention to what comes next. Because the compounding math is more powerful than most people realize, and I'm going to show you exactly which funds capture it most efficiently and which behavioral traps erase it. Once you understand how those two forces interact, you will never look at a market drop the same way again. That starts with the number itself and what $4 million actually promises. $4 million. Just sit with that number for a second. Not $4 million from a salary. Not $4 million from a business exit, an inheritance, or a lucky stock pick. $4 million from a single, one-time investment of $100,000 left completely alone for 30 years. No additional contributions, no market timing, no active management, just 3 index funds and 3 decades of patience. That is not a sales pitch. That is the math. And it is worth understanding precisely because the details matter more than the headline. Here's how the compounding actually builds. In the early years, the growth feels almost invisible at a blended average annual return of roughly 9%, which reflects the long-run historical average of a diversified U.S. equity portfolio. $100,000 becomes approximately $236,000 by year 10. You have more than doubled your money without touching it once. But here is what most people miss. You only earned about $136,000 in that first decade. The engine is just warming up. By year 20, the same portfolio has grown to approximately $560,000. Notice what happened. You earned more in the second decade than in the first and second decades combined. That is compounding, doing what it actually does. Not growing linearly, but accelerating. Each year's return is calculated on a larger base than the year before. By year 30, a broad total market approach brings that number to approximately $3.9 million. You put in $100,000. Time and compound growth produced the other $3.8 million. You did not earn that through skill or effort. You earned it through structure and patience. Now here is where the story gets more honest. That $3.9 million is a nominal number. It reflects the raw dollar amount sitting in the account. What it does not reflect is what those dollars can actually buy 30 years from now. Because inflation quietly erodes purchasing power every single year. At a historically consistent 3% annual inflation rate, which aligns with current long-run Federal Reserve projections, that $3.9 million in future dollars is worth closer to $1.6 million in today's purchasing power. Still extraordinary. Still life-changing. But not the same number. Let me show you what that looks like with a more conservative portfolio as well. Because not everyone will hold an aggressive equity allocation for 30 straight years. A standard blended portfolio, something like 60% equities, 40% bonds, grows $100,000 to roughly $998,000 in nominal terms over 30 years, just under $1 million. Impressive on paper. Adjust for inflation, and the real purchasing power lands at around $412,000. You quadrupled your money's actual value. That is a genuinely strong outcome. But it is a very different feeling than the $1 million headline suggested. And that gap between the nominal number and the real number is the first thing most investment projections quietly leave out. Think about someone like Marcus, a 34-year-old project manager in Atlanta, currently putting away money for the first time. He sees a projection showing his $100,000 becoming $1 million in 30 years and feels a deep sense of relief. The math is working. But nobody told Marcus that his million, when he reaches 64, will be spent more like 400,000 in today's terms. His retirement plan is technically correct and practically incomplete at the same time. This is not a reason to feel discouraged. It is a reason to be precise. The compounding math is real, and it is powerful. Inflation does not cancel it. It just means the nominal number is not the whole story. And anyone who presents it without the inflation adjustment is either not paying attention or hoping you are not. So the engine works. The question now is what you are actually putting into it. Because when most people buy a diversified index fund, they assume they are spreading their risk evenly across the market. That assumption is the illusion of diversification, and it is costing people more than they realize. Here is something worth pausing on. The word diversification is probably the most confidently misused word in personal finance. People say it like it solves something, like owning an index fund with 500 companies in it means you are protected from concentration risk. That assumption has a long and expensive history of being wrong. Go back to 1929. The Florida land boom of the mid-20s had convinced ordinary Americans that real estate, swampland included, was a guaranteed path to effortless wealth. People bought parcels they had never seen, in places they had never been, because everyone around them was doing it, and the story made sense. Until it did not. The paper fortunes evaporated almost overnight, and the people who thought they were diversified across multiple properties realized too late that they all shared the same underlying risk, a narrative that had stopped being true. Fast forward to 1972. The smartest institutional money on Wall Street had concentrated into what they called the Nifty 50. 50 blue-chip American companies considered so dominant, so structurally essential, that paying 90 times earnings for them felt rational. Xerox, Polaroid, Avon. These were not speculative bets. These were household names with decades of track records. When the crash of 1973 and 1974 arrived, Polaroid dropped 91%. Avon fell 86%. The companies did not disappear. The valuation story did. What both episodes share is not stupidity. The people involved were not reckless. They were doing what felt like the reasonable thing, given what everyone around them believed. That is what makes concentration risk so dangerous. It does not feel like a risk when you are inside it. Now bring that pattern forward to today. Imagine a restaurant owner named Diana. She runs a 40-seat place in Denver, and her menu has 32 items. On paper, she is completely diversified. If the soup does not sell on a Tuesday, she has 31 other dishes covering the loss. But when Diana finally pulls her sales data, she finds that 7 dishes generate 83% of her revenue. The rest of the menu exists. It just does not really matter. If food trends shift, if one key supplier has a bad season, if the neighborhood demographics change, Diana is not as protected as her menu length suggests. She has the appearance of diversification and the reality of concentration. That is exactly what is happening inside the S&P 500 right now. The index contains 500 companies. That sounds meaningfully spread out. But currently, the 10 largest holdings, nearly all of them large-cap technology companies, account for roughly 35% of the entire index's value. Microsoft, Apple, Nvidia, Amazon, Alphabet. When you buy a standard S&P 500 fund, you're not making 500 equal bets. You're making a heavily weighted bet on a small group of companies that happen to be enormous. And that creates a specific, underappreciated problem. When those companies have a bad quarter, when a regulatory decision lands wrong, when an earnings report disappoints, when the broader sentiment around technology shifts, your supposedly diversified portfolio moves in lockstep with that handful of stocks. The 500 company label is still technically accurate. It just stops being meaningful in the moments when diversification is supposed to protect you most. Consider someone like Trevor, a 41-year-old logistics manager in Phoenix, who moved his savings into an S&P 500 index fund 3 years ago because he read it was the responsible, diversified choice. He felt safe. Then a stretch of pressure on large-cap tech names trimmed his portfolio by more than he expected, faster than he expected. And the experience shook him enough that he started second-guessing the whole approach. Trevor did not make a bad decision. He made an incomplete one. He bought diversification as an idea without fully understanding what he actually owned. This is not an argument against index funds. It is an argument for knowing precisely what is inside the one you choose, because the fund selection is where you either inherit that concentration problem or sidestep it. And that is exactly what the three funds for growth are designed to do. Most people approach fund selection like they are choosing a restaurant from a review app. They look at the star rating, pick the most popular one, and assume the decision is made. But popularity in investing is not the same as fit. And fit, it turns out, is almost everything. The goal here is not to find something exotic. Index funds remain the most reliable, lowest friction vehicle for long-term compounding that exists. The research on active management is not ambiguous. Over any 15-year period, roughly 80 to 90% of actively managed funds underperform their benchmark index after fees. That number has been consistent for decades. So the question is never index fund versus something else. The question is which index fund and why. There are three approaches worth understanding in detail. The first targets small cap growth. The Vanguard Small Cap ETF, ticker VB, currently holds over 1,500 smaller U.S. companies across a wide range of industries. The average market cap inside this fund is nowhere near the Apples and Microsofts of the world. These are businesses with room to expand, not businesses trying to defend territory they already own. Historically, small cap stocks have outperformed large cap stocks over long time horizons, though with meaningfully more short-term volatility. That volatility is the trade. If you have 30 years and the temperament to hold through rough stretches, the small cap premium has rewarded patient investors consistently. The expense ratio on VB is currently just 0.05% annually on a $100,000 investment that is $50 a year in fees, essentially nothing. The second approach hunts for value in established companies. The Wisdom Tree U.S. Value Fund, ticker WTV, screens for profitable, cash-generating businesses trading below their intrinsic worth. These are not glamorous companies. They are not the ones showing up in financial headlines, but they tend to hold up significantly better when markets get turbulent because their valuations were never built on optimism in the first place. Value investing has gone through long stretches of underperformance relative to growth. The 2010s were particularly brutal for value investors, but the mean reversion has historically been real. When growth names compress, value names often provide ballast. The expense ratio here sits at 0.12%, still negligible relative to the protection it adds. The third approach captures everything. The Fidelity Total Market Index Fund, ticker FSKAX, holds over 10,000 U.S. companies across all market caps, all sectors, all stages of growth. It is the broadest possible bet on the American economy continuing to function. It includes large caps, mid caps, small caps, and micro caps in proportion to their actual market weight. The expense ratio is 0.02%. That is $2 annually on every $10,000 invested. It is, by almost any measure, one of the most cost-efficient investment vehicles ever created. Now, here is where the fee conversation gets important, because most people underestimate what fees actually cost over time. Take two investors. Both start with $100,000. Both earn an identical 9% gross return annually for 30 years. The first is in a fund charging 0.02% in annual fees. The second is in an actively managed fund charging 1% annually, which is actually below average for active management. After 30 years, the first investor ends up with approximately $3.8 million. The second ends up with approximately $2.9 million. Same market, same starting amount, same time horizon. The difference is $900,000 paid quietly in fees across 3 decades, 1 year at a time, in amounts small enough to never feel significant. That is the mechanism the financial industry prefers you not run. Not because it is a secret, the math is publicly available, but because the number only becomes visible when you extend the time horizon far enough to see it. Selecting the right fund takes about 20 minutes of honest research. The expense ratio is printed on the fund's fact sheet. The holdings are publicly listed. There is no hidden information here, just a decision that most people make once and never revisit. That decision is the easy part. What happens in the 30 years after it, every time the market drops and the instinct to act becomes overwhelming, that is where the real cost of being human shows up. There is a statistic that does not get nearly enough attention. Studies tracking investor behavior consistently show that the average U.S. equity fund has returned roughly 8% annually over the past 2 decades. The average investor sitting inside that exact same fund has captured closer to 5.5%. Same fund, same market, a 2.5% gap every single year for 20 years. That gap has a name. It is called the behavior gap, and it is entirely self-inflicted. The fund did not underperform. The person did. Understanding why that happens requires being honest about something most financial content skips over entirely. The human brain was not built for this. When a portfolio drops $30,000 in a month, the neurological response is functionally identical to a physical threat. Cortisol spikes. The mind narrows. The instinct is to act, to stop the bleeding, to do something. That response kept human beings alive for hundreds of thousands of years. In a brokerage account, it is catastrophically expensive. Behavioral alpha is the term researchers use to describe the financial advantage you gain simply by not acting on that instinct. It is not a strategy in the traditional sense. There is no chart to read, no indicator to track. It is the return you keep by overriding the part of your brain that evolved to run from danger, not sit calmly while watching a number fall. Here's what that 2.5% gap actually costs over time. Start with $100,000. At 8% annually over 30 years, you end up with approximately $1,006,000. At 5.5% annually over the same 30 years, you end up with approximately $492,000. The difference is just over $500,000. Not lost in a bad investment, not lost in a market crash, lost in the transaction costs of emotional decision-making, buying after markets recovered, selling after they dropped, repeating that sequence enough times to cut the outcome nearly in half. Now meet someone like Carla, a 38-year-old nurse in Minneapolis who invested $80,000 into a total market index fund in early 2020, just before the pandemic crash. Within 6 weeks, her account was down to roughly $53,000, a $27,000 paper loss in under 2 months. Carla sold. She told herself she would buy back in when things stabilized. By the time she felt comfortable re-entering, the market had already recovered most of the drop. She missed the rebound, locked in the loss, and spent the next 2 years trying to catch up to where she would have been if she had simply held. The fund recovered a fine. Carla's account did not. That story is not unusual. It is the default outcome for investors who have never thought through what they will actually do when the number on the screen gets frightening. There is a second, less discussed mechanism that compounds this problem. It is called sequence of returns risk, and it operates completely differently depending on where you are in your investing life. If a 30% market drop happens in your first decade of investing, it is genuinely a gift. You are buying shares at a discount. Every contribution you make during the downturn purchases more units at lower prices, and when the recovery comes, and historically it always has, those discounted shares multiply. The crash accelerates your accumulation. Early investors should almost welcome volatility. But if that same 30% drop arrives in the first 2 or 3 years of retirement, the math reverses entirely. You are no longer buying. You are selling, liquidating shares to cover living expenses at exactly the wrong moment. Each withdrawal removes units from the account permanently, units that will never participate in the recovery. The sequence of when returns arrive matters as much as the returns themselves. The structural solution is straightforward. Keep 3 years of living expenses in cash or short-term instruments, completely outside the market. Leave everything beyond that time horizon in the index funds, untouched. That buffer means a market crash does not force a sale. It removes the gun from the equation. Segmentation handles the timing problem. It protects the math from the moment. What it cannot protect against is something quieter. What happens psychologically when the number keeps growing? The goal keeps shifting, and success itself becomes the thing that derails the plan. That is a different failure mode entirely, and it lives at the heart of defining your enough. Nobody talks about the investor who did everything right and still ended up miserable. It does not make for a compelling cautionary tale because there is no obvious villain. No panic selling, no bad fund, no timing mistake. Just a person who kept accumulating long past the point where it served them, chasing a number that kept moving, never quite arriving at the feeling they were building toward. That failure mode is quieter than the others. It is also more common than most people admit. Psychologists call it the hedonic treadmill. The basic mechanism is this. Human beings adapt to new levels of wealth remarkably quickly. The thing you wanted becomes the new baseline, and the baseline never feels like enough. You hit 500,000 and the mind recalibrates to a million. You hit a million and it recalibrates to 2. Not because you are greedy in any conscious sense, but because the brain is extraordinarily good at normalizing whatever it currently has and redirecting attention toward whatever it does not. In everyday life, this is mildly inconvenient. In the late stages of a long-term investment plan, it becomes genuinely dangerous. Here is why. An investor in their late accumulation phase, say late 50s, 15 or 20 years into a disciplined strategy, has typically built a portfolio large enough that the temptation to optimize becomes acute. The money is real now. The stakes feel higher. And if there is no defined endpoint, no number that constitutes enough, the mind starts looking for ways to accelerate. Concentrated positions, individual stocks, higher risk instruments that promise faster growth. The irony is that the people most likely to blow up a carefully constructed portfolio in the final stretch are not beginners. They are experienced investors who forgot to decide when they were done. So define the number before you need it. Here is what the math looks like on a concrete target. Take $2 million as a personal enough figure at a 4% annual withdrawal rate, which is the standard benchmark derived from long-run research on portfolio sustainability across 30-year retirements. $2 million generates $80,000 per year in income, indefinitely. The principal, invested in a balanced portfolio, continues to grow at a rate that historically keeps pace with or exceeds the withdrawal. You are not spending down. You are living off the return while the base remains largely intact. $80,000 a year is, for most households in most American cities, a genuinely comfortable income. It is not extravagant. It is not constrained. It is enough, by almost any practical definition of that word. Now consider someone like Raymond, a 51-year-old civil engineer in Charlotte, who hit his $2 million portfolio target 18 months ago. He had identified that number years earlier as his enough figure, done the 4% math, and understood exactly what it meant for his life. When he crossed the threshold, he did not keep pushing. He shifted his allocation toward preservation, reduced his equity exposure, and started planning the transition out of full-time work. Raymond did not feel the pull to keep accumulating because the destination had been defined clearly enough that arriving at it actually felt like arriving. That clarity did not happen automatically. Raymond had written an investment policy statement years before, a short document, maybe 2 pages, written when markets were calm and his thinking was clear. It named his target number. It specified his asset allocation at each stage. It set a hard rule that individual stock positions would never exceed 5% of the total portfolio. And it included one instruction he told himself he was not allowed to override. When the number is reached, stop accumulating and start transitioning. The investment policy statement sounds like a formality. It is not. It is the document your future self will need when the market is up 30% and every instinct says to let it ride just a little longer. It is the pre-committed answer to a question you cannot trust yourself to answer in the moment. Write it when you are calm. Follow it when you are not. The entire arc of this comes down to one governing principle, and it is almost insultingly simple once you see it. The market rewards patience and punishes activity. Doing nothing during a crash is a strategy. Holding past the point of comfort is a strategy. Knowing when you have reached enough and stopping is a strategy. The investors who build durable outcomes are almost always the ones who acted least. And that realization is really what this whole journey points toward. Here is what this whole video really comes down to. The math was never the hard part. $100,000, 3 low-cost funds, 30 years of patience. The compounding engine does exactly what it promises. The hard part is building the conditions that let it run. The structural conditions. Segmenting your money so a crash never forces a sale. The behavioral conditions. Closing the gap between what the fund returns and what you actually capture. The psychological conditions. Defining enough before success starts moving the goalposts on you. Those 3 things, structure, behavior, and a defined endpoint, are what separate the people who build durable outcomes from the people who had the right funds and still fell short. Watch for the moment when doing something feels more responsible than doing nothing. That feeling is almost always wrong. The investors who build lasting wealth are almost always the ones who acted least. There is one question this video did not fully answer. $2 million generates 80,000 a year today, but inflation, tax law, and life do not hold still for 30 years. How do you build a number that stays meaningful when the world around it keeps changing? That is worth thinking about carefully, and it is exactly where we are going next.